Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. This episode features Tim Laehy. Tim has got a super interesting background. He was brought into Coinbase in Q3 of 2017 and was there through Q3 2018. He was brought in specifically to build and manage their global financial operations and financial initiatives. While at Coinbase, Tim got to see a company go through rapid growth. His thoughts on that are really interesting. He's been brought in a number of times to get companies ready for going public. He's done a number of secondaries. The guy has a really interesting career, and I enjoyed getting to know him. This episode is sponsored by Bastier Partners, a boutique investment bank. Bastier's founder and managing member is Nader Afshar, a fan of the pod. Nader is described as a connector, high integrity, a low-key version of Byron Trott, and the rare investment banker that focuses on the alignment of interests and incentives. I appreciate him allowing me to research his firm a little and appreciate his support of the pod. Thank you to Bastier. As always, none of this is financial advice. All of the information contained in this program is for entertainment purposes only. Please consult your financial advisor before making investment decisions and do your own due diligence. Hope you enjoy this one. Thrilled to be joined by Tim Laehy. Tim, how you doing today?
I'm doing great, thanks.
Thank you for joining me.
Thank you for inviting me.
Introduced through Luis Sanchez, if I'm not mistaken, correct?
Yes, yeah. Luis and I have actually never met in person, but we had a very lengthy call talking about Coinbase, and I think that led to this conversation.
Indeed. Do you want to give people a little bit of your background so that we level set where you're coming from?
Sure. So first of all, I'm based here in San Francisco, and I've been CFO of multiple companies across a lot of different industries, including cryptocurrency and the related broker and exchange market, but also SaaS companies, enterprise software, other services companies. I've got extensive experience with both public and private companies and have fairly deep capital markets expertise. I've been CFO of 9 companies now, and typically my exposure to these companies is I'm the first CFO brought in, typically later stage private, looking to go public, and my sweet spot is getting companies ready to be public companies, and that's worth a conversation in and of itself. But also, I've helped companies grow and go through the acquisition on the sell side, M&A side, and all 3 of companies I've helped to grow and sell, all tech based, by the way, all VC backed, all based in the Bay Area. 3 of them were acquired by Fortune 100 firms, and I typically stay on for a period of about 6 to 8 months to help integrate. But that's a quick background. I can dive into kind of how I got into the world of being a CFO, but I don't know if that's outside of the scope.
I would be fascinated by that. But I just want to. So, if memory serves me correctly, you've taken 3 companies public, 7 secondaries, and now 3 acquisitions?
Well, 3 sell side acquisitions, or going through the selling process of the company. But I've actually led the finance effort and the corporate finance effort to acquire 9 companies. And the hard part there is not only finding the right company, but negotiating the deal, and then ultimately the hardest part is to integrate them to be a successful M&A. But yeah, so I have a lot of deep domain expertise there.
Yeah, it sounds as though you really like the due diligence process.
Well, it's
and road shows.
Necessary evil, I would say. I wouldn't say evil. It is fun. So the role of a CFO is interesting. You've got, obviously, it depends on what stage the company is. But if it's an earlier stage private, venture-backed company looking to be public or looking to grow and be independent, the thing that we all have to do is have a kind of an inward facing persona as well as an outward facing persona, meaning, working with investors. And in private companies, obviously you're dealing with private investors, and some of them are crossover investors. But as you get closer and closer to being a public company, or actually having gone through the IPO process or the DPO process, depending which if you do a direct placement these days, dealing with institutional investors, the sell side analysts, the buy side analysts, those are all really kind of detailed conversations, and it's a whole different way to speak. So you have the inner or working operationally and leading the company internally, and then there's the exterior, outward facing activity where typically the CEO and CFO are the typical point people. So yeah, it's a learned expertise. The first time around, I remember the first presentation I gave as a CFO, IPO back. This is in the late '90s, to a room of 200 people was terrifying. Now it's not a big deal, but yeah, diligence is a big part of it. And it would be remiss of me to avoid talking about the great teams of people behind the CFO and behind the company that do most of the work. And shout out to all of them for doing such great work and allowing me to do my job.
So, what does that look like when you're brought into a late stage company that's getting ready to go public? How much, I mean, what's kind of the typical blueprint here? I assume you need to professionalize the finance arm a little bit.
Very much so. Yes. And it all depends. It's a complex answer because all businesses are slightly different. And the beauty of being a tech CFO is our skills are fungible. We can move between industries. I would say 80% of what we do is highly transferable. And the other 20% is unique to that particular industry or that type of revenue model or business model. So if I were to draw some common denominators, having come into so many companies as its first CFO, the typical scenario you find is the CFO is one of the last executive hires made. So companies typically, they sprout up, tech companies sprout up with a great idea. They get incubated, they go through their seed round, they start building a product, so focus on product and engineering. Then once they get a good product market fit, they start thinking about monetizing that business, which means they need a sales team or a go-to-market a team, whether it's marketing driven sales channel or just straight account executive sales channel. But then marketing will support that effort, and then ultimately you get to the point where a lot of the focus is on growing the top line, and all of those pesky little control issues that no one thinks about that kind of push them into the corner. All of a sudden, when people or companies and investors start to want to put their companies in position to go public, you have to go through an IPO readiness process, which means you have to kind of unpack everything. And typically, I've seen that administrative debt is, there's always technical debt that companies, tech companies go through where they push things aside and then have to go back and backfill. But in the world of accounting and finance and legal and HR, most of the administrative side of the business, there's a lot of built up debt. And so the first thing that I would do, depending on how complex that is to get a game plan together to unwind that, or to build the proper controls and process and discipline necessary to go through a Big Four audit with no material weaknesses and no audit adjustments. That's pretty critical. And so I would say that that's a lot of heavy lifting. You can't do it by yourself. What I do is rely on third parties to come in and help to frame that process of establishing processes, controls and systems to support those controls. And that's done through people that do it 5 times a year versus people that do it, once or twice in their career. So I've typically leaned on outside resources to help structure that and then start hiring talent to backfill and to not necessarily build those controls and processes, but to use those controls and processes that are built that are based on the systems that are needed to support the business. And so what I'd like to do is hire talent that has been there before. It's always easier to work with somebody in a position like a chief accounting officer. I'm not an accountant, full disclosure. I'm not a CPA. I didn't come up the ranks through the accounting world. I came up through treasury, corporate finance, and investment banking. And so I rely on a head of accounting to be the principal knowledge base of that discipline. And that also means that they would have to ultimately own the control environment. And people that have been in the end zone before, using a football analogy, that they know what it's like to be in the end zone versus starting out on the 1 yard line and marching down the field for the first time. And how do you actually cross that goal line? And that's something that's a learned behavior. And it's always nice to work with people who have done it before. And I'd like to push that through the entire organization. That is the finance, accounting, treasury, investor relations, all of the finance functions. So it's a skill that's learned over time. Like I said, it's my 9th CFO gig. I'm with a new company now. It's been almost a year, actually. We just closed a Series B financing. That was interesting. We can talk about that given the current venture climate. But I'm excited that we are kicking off. In fact, we just kicked off last month that whole process that I just described of identifying the processes. These are things like order to cash or record to report or procure to pay or equity or revenue, all of the detail that has to go behind that to make sure that it works and it works repeatedly. And you test it several times before you actually go live, being a public company where you have to live and die by the ability to meet your guidance and forecasts.
I had a friend that was venture backed by a well-known firm, and he said that he thought that it was a little bit of a misnomer that Wall Street is necessarily short-term focused, because he said, my investors know everything that I'm doing almost on a week-to-week basis. But maybe the difference is they have a slightly longer time horizon than the typical public investor. Do you think that's an accurate statement, or have you found that once you're public, it's a little bit shorter term in nature?
Yeah, it's interesting. I encourage the CEOs that I work with and the boards that I inherit typically to take advantage of being private as long as you can. And I mean, it's no joyride being a public company. There's a lot of reasons to go public, but it comes with its downside also, which is you go from looking at the 2-3 year horizon to looking at the 3-month horizon and making decisions that will not disturb the guidance that you give the street. And to be a public company, it requires a number of things. Obviously, you've got to have certainty in your business, you have maturity in the business, repeatability, but the ability to forecast the future and forecast it accurately and do it over and over and over. Look at Microsoft. They grew at 50% a year for 15 years straight and never missed earnings guidance. And look at what happened to their market cap. So you don't need to be the highest growth company. You need to be predictable, forecastable. And then when you give guidance as a CFO and any earnings call transcript that you review, you'll see that the CFO is giving not only revenue guidance, but earnings per share guidance, not only for the next quarter, but potentially for that full year. And there's this concept called a beat and raise model that the good investor relations teams are able to guide the guide the CEO and CFO to be able to beat the number that you give the Wall Street analysts who are giving guidance on the stock selections. So, and then be able to not only meet it or beat it, and then be able to raise your numbers. And that's just it's a flywheel that really works well. Takes a lot of discipline, but also takes an underlying business that's predictable. And so I think the first thing people need to think about before they even think about going public is this a predictable business that is repeatable? And you obviously have to have an industry that's growing. You have to have a management team that knows what they're doing, that can execute. You have to have the right financial sponsorship. You have to have the right growth rate and need in the market. So there's a laundry list of about 10, 12 items that need to exist. But IPOs and being a public company are not for everybody. And you can see, I don't want to go down a rabbit hole here, but you can see that whole craze on SPACs over the last couple of years. It really led to a lot of companies that entered the public market before they were really able to, and before they were able to have that control environment build and have that predictability of their revenue and earning streams. So again, it's not for the faint of heart. It's sitting in front of, I remember the one time I was sitting in front of, I think it must have been 7 different Fidelity mutual fund managers, several $1 trillion under management in front of me, grilling me because the CEO was late, his plane got delayed. It can be a very difficult time.
So when you're talking about predictability, I think about what Coinbase or really any of the trading firms went through 2020 and 2021. I mean, if you're trying to forecast off of, and I mean, I don't care if it's streaming, software, whatever, with COVID, how as a CFO would you be thinking about, like, how am I going to guide here? Because the trading volume exploded, right? So it makes the forecasting of the future very, very difficult.
Yeah, it's interesting. I read I subscribe to Seeking Alpha, and I read every morning my cup of coffee, and I read a few of my news feeds. And this morning there was a great article about, is the pandemic profit party over? And there's a lot of companies that really benefited from people working from home or building materials or whatnot, that were in short supply. So it was really a two-edged sword. Well, worse than that, my heart goes out.
Well, we're just talking about finance, yeah.
Yeah. But anyway, on the finance side, I would say that it really did put a wrinkle in a lot of companies and their ability to manage themselves, just because they didn't have that face-to-face interaction with their employees. Their customer bases were disturbed. And it did change the ability for companies to really predict themselves. So the best companies figured it out pretty quickly. And then those that actually benefited from that uncertainty really rose to the surface. And then there were a lot of casualties too. So when you bring volatility and changes to a predictable future into the mix, all kinds of things can happen. But I think the best run companies were able to navigate those waters. And it's interesting to see. The company I'm with now is it's somewhere between a B2B play and a B2C play. And because the customers are 1 or 2 seats, it's a software platform. And so we really need to address the needs of those customers in that changing world where information now is taking on a whole new meaning. So yeah, it's a tough question to answer. I don't think there's any one right answer. It's something that we talk about in board meetings pretty extensively. And then, obviously this war in Ukraine impacts a lot of us. Company I'm with now has several of our software developers are based in Eastern Europe, and that their lives have been disturbed. And then the development of our software obviously is being disturbed. So business continuity, disaster recovery, all of that takes a new meaning, especially in the days of a lot of these phishing and cyber attacks. So yeah, it's a interesting time to be in business.
Yeah. What do you want to mention? What company you're with right now?
Oh, sure. Company's name is CREXI. It stands for Commercial Real Estate Exchange Inc. It's think of us as Zillow for commercial. It's not really like Zillow, but it's a marketplace for users to be able to buy or sell or lease commercial real estate. It's a huge market. And what attracted me to it is if you think about global wealth, and this could take a couple of minutes, but it's really interesting.
No, I'd love
way to
just
look
go
at it.
on and you can talk as long as you want.
Oh, sure. So if you think about global wealth, roughly estimated to be $380 trillion. And of that 380 trillion, three quarters of that, $280 trillion is wrapped up in real estate. So humans put a lot of value in real estate. They store value in real estate, they pass it along generation to generation. And within that 280 trillion, it's about 70 trillion, plus or minus 100 billion, which is, big rounding error, but about 70 trillion is commercial, meaning it's not a single family residence. It's a piece of property that was purchased to get a return. And it's not, people aren't worried about the school district or number of bathrooms or what the street front looks like. These are commercial properties, and they could be any type of property. They could be vacant land. It could be, interestingly enough, office buildings is one of the smallest asset classes within this large asset class. Self-storage units, assisted living centers, mobile home parks, you name it. Just drive down any major street in any major city, 90% of the buildings you see are commercial buildings. So it's historically and by the way, that's global. $70 trillion business is global. 16 trillion is estimated, 16, 17 trillion is estimated US alone. And so it's one of the world's largest asset classes, and it's currently illiquid, it's underserved, and it's not digitized. So what CREXI is a new age marketplace for commercial real estate. There's no MLS for commercial. We hope to be that. In fact, we just launched property records, which we now have property records on every single commercial property in the country. And so we give and get access to information which not only talks about what the current state of that property is, but historically how that property has behaved. What lease rates were, what vacancy rates, what mortgages level, any history of default, sunny days, foot traffic, automobile traffic, pretty much any data you want around that commercial property can lead to market intelligence. So our platform serves both the sales and lease market. It provides market intelligence and forecasts for buyers and sellers, and it improves speed, efficiency, and liquidity for transactions that are completed on the platform. So over time, our platform is going to allow investors to buy real estate as easily as investing in the stock market today. And I'm old enough to know what it used to be like to invest in the stock market when you call up your broker over the phone. They place the order, manually. It went to the New York Stock Exchange. They traded paper. They sent you a paper-based stock certificate. It took weeks or longer to execute the trade, to finalize the trade through clearing and settlement. And now you can go on TD Ameritrade or Schwab or Robinhood for almost $0. You can instantly own your asset, own your stock. I think that's where this is going with real estate, which means that things are going to have to change. There's going to have to be best-in-class tools built for market intelligence, for predictive analytics, for instant on-platform transaction processing. It's game-changing when compared to the analog version of commercial real estate that's being used today that maybe my grandpa used to do. And so it's bringing software to an old-school problem, and you don't find asset classes this large that are not digitized. And so it's going to be a long process of transformation. But coming out of the blockchain world, and we can talk about my time at Coinbase, but I believe that this real asset, these commercial properties that are in existence for returns on investment, they are just screaming for a technology like blockchain to be the source of truth, the place where data is stored. And ultimately, with fractionalization or tokenization of properties, now we can get into where individuals, these are small investors, could own a piece of a building or a piece of a portfolio of multiple buildings. And so this is my own personal belief, but I think this whole commercial real estate sector is ripe for change, and there's going to be, just like in any disruptive business, there's going to be billions of dollars to be made, and there's no reason why we can't be that one.
So when you say that you have all the data, is that like proprietary input, or is CoStar like a data provider and you're using their data and then you're gonna like build your platform on top of that? I'm just trying to figure out how you're different from them. And
Sure. Well, first of all, we have multiple revenue streams, and one revenue stream allows buyers and sellers or landlords and tenants to find each other. So it's the marketplace. The other revenue stream, and so people, typically listing agents, pay for that, and they get all kinds of market intelligence as well as just the place to find real estate. The other product we have, another project we have, is another recurring revenue stream, is our market intelligence product. And that provides that predictive analytics and a lot of first-party data augmented with third-party data. And we apply machine learning to that to be able to give more insights than what's currently available. Interesting enough, and again, I'm a newcomer to, it's only 10 months on the job so far, but I'm a newcomer to commercial real estate. But most people buy commercial real estate on cap rates and comps. And that's all kind of driving, looking in the rearview mirror. It's all looking backwards. What we're trying to do is augment first-party and third-party data through machine learning to be able to draw predictions. And so that is, again, another subscription service. And then the third current revenue stream, and there could be more in the future, is to run transactions directly over our platform. We're more of a white glove service, where if somebody wants to sell their property, we will market it for them and we'll take it all the way through escrow and close. Although we're not an escrow company or a title company, those are relationships that we currently have. Who's to say if ultimately down the road sometime we don't take on that role also? But you mentioned CoStar. CoStar is a competitor. They're the largest competitor. They have multiple revenue streams also. We do not use any CoStar data. In fact, we're kind of the anti-CoStar. We make it very easy for our users to list properties. We don't charge them on a per listing basis. There's a lot of benefits you get with Crexy. It's much less expensive. It's much faster. We're a new age company. CoStar has kind of been around since the beginning of the internet, and their website kind of looks like the beginning of the internet. But again, I don't want to talk about CoStar. What we do is we get first-party data, which is generated by either the listing agents or property owners uploading information through an offering memorandum, which is digitized. And then we also have other first-party data that we learn from the listing agents or from the sellers. And then we also have first-party data from potential buyers, because on the demand side, there's literally a 20x increase of users on the demand side, because the supply side is really just the owners of the property and their associated brokers or agents. On the demand side, you not only have principals and transactions, current owners, prospective new investors, all the escrow companies and title companies and appraisers, fire extinguisher management companies, property managers, you name it. There's all kinds of users on the demand side that want to learn more and more about these commercial properties. And the way that we've structured our data really will be the sole source of all data or all properties domestically. Ultimately, there is an opportunity for international expansion, but that's down the road.
So if we're going to a world where there's tokenized ownership in these buildings or whatnot, like say I sign on and I'm looking to purchase a fraction of a building, am I do I get access to like a data room or something like that? And how do I know that the data that I'm relying on is accurate?
Sure, absolutely. It's a great question, and there's no there's no defined answer. We're quite a ways away from that. You haven't seen digitization or fractionalization of real estate working yet. There's been a few companies that have tried. They've raised a ton of venture money, but nothing's really come of it. It's really early days for that. So as far as how you get your diligence, how you get your information, I would say it's, again, I don't have the answer, but I think the way that you get access to a diversified pool of real estate, commercial real estate today with any liquidity is through a REIT. And you pay up for that. You probably give up 30, 40 basis points just to get access to that liquidity. But you'll be getting the same type of information as you would be getting through a REIT. But then again, it could be much, much more. It's kind of like, what information are you getting today out of it if you bought an NFT or if you were to buy any digital currency or digital asset? You'll have to do a lot of the background diligence on your own. But then again, given Crexy has the ability to build products based on all this data, we can package it in such a way to give you dashboards and indicators of future value. Again, we're not investment advisors, and I'm talking about something that's 5, 6,
far
7
out
years
there,
down
but
the
we're
road.
just talking about the vision of it.
Yeah, but it's yet to be defined, and that's the beauty. And I think there's going to be a lot of venture money going into prop tech, especially commercial prop tech. You see a lot on the residential side already. Zillow, Redfin, Homes.com, you name it. There's dozens of them, and in aggregate, it's $100 billion of value. I'm making that up, but it's a large number. So yeah, this is being developed, and what we've done is taken a broker-friendly approach. We know that we're smart enough, or at least the CEO is smart enough to know that you don't want to go in and disrupt the whole market and put brokers out of business. They're our customers. Eventually, just like in the days of stockbrokers, there's no more E.F. Hutton or Dean Witter brokers, at least that I know of. There are still stockbrokers, but it's a whole different job these days. They make their money differently. There's lower fees, but a lot more volume. So yeah, this is a new asset class on the verge of transforming, and that's why I joined. It wasn't because I'm a big, huge commercial real estate guy, but I think I can take my knowledge that's transferable from other tech industries into Crexy and help get it ready to be public and riding this huge market shift that's taking place. It's exciting. It's super exciting. And the interesting thing is there's not a lot of competitors. There's a few, but we have multiple revenue streams, and there's different competitors in each one of those revenue streams. But as far as anybody doing everything that we do, we're still small. We do a lot. I think we're just approaching 300 employees. We're nationwide. We've got offices around the country. It's interesting with kind of the remote work. The last couple of years of people working from home or not in the office, that's changing. And we just took on a new space. In the company's based in Los Angeles. I'm the only Bay Area employee, but we're just moving into a new location to absorb the size and the growth of the business in Playa Vista. But it's we're expecting people to be in the office, and of course, there's going to be some people that don't come in the office for whatever reason. 2 years of hiring remotely, people might have a 2-3 hour commute if they were expected to come in the office every day. But going forward, we're going to be really encouraging people to come into the office, and it's changing the way that businesses run. But we have offices in other parts of the country also, and looking to grow these centers of excellence that might be focused on customer support or sales or engineering or technology, depending on which location and what the center of talent is. So it's fun. It's fun growing, being involved in another earlier stage company and growing it and getting it ready to be a standalone, independent potentially public company, but that's down the road.
Yeah, that sounds cool. What was you had mentioned that it was you just raised a Series B, and then you mentioned the current venture climate. What's the current venture climate like?
Well, it's public knowledge. Q1 was difficult. There were coming off of a banner year, 2021, especially in prop tech, but across the spectrum, it was a really frothy year. And then Q1 was a pullback. And the good news was we were far enough into our Series B and had term sheets and documentation was already starting to be drafted that the investors that came in were all in. So we were fortunate enough to be able to close our Series B pretty much unscathed. But I think for others that are looking to raise early stage money, I think that's going to be a lot harder. I've been fortunate enough to been through a lot of boom bust cycles. I think there's been 4 of them that I can name. But they seem to recover. They seem to always recover, and they seem to come back, more stronger and with more energy than the prior one. So who knows? Like 7 years ago, 5 years ago, no one was talking about the metaverse. No one was talking about NFTs. No one was talking about crypto at this level. Now we're talking about it as almost standard. And what's going to happen in the next 5 to 7 years? There's just new technology that's popping up, and it's exciting. But yeah, the fundraising climate is tough. I mentioned SPACs, and that's kind of the blooms off the rose there. So I think there's you can see the IPO window has been shut for a while now, and it's just reopening. I think just read there's several IPOs that are kind of on the horizon, including Steinway doing their IPNOO or whatever they call it. But that's it's pretty interesting times.
Yeah, I have. I actually was just talking with somebody yesterday that said that it looked like the IPO window is going to open because I guess there've been a fair amount of secondaries that have come out here in the not too distant past, and he's an investment banker, so he was happy to see it.
Yeah, and just getting access to that first influx of public equity is one thing, but public companies, as you know, they go out and do secondary offerings. And you mentioned earlier in my background, I've participated in multiple secondary offerings and pretty much all forms of capital, whether it's high yield debt or bank debt or private equity or public equity. But it's a never-ending cycle, and as long as you can prove that you have good use of funds for those proceeds, and you could take advantage of low interest rates. I think every well-run company is going to have some level of debt. So it's an interesting time, obviously with inflation and the risk-free rate of return increasing. It's gone up 100 basis points in 12 months. That's, I think, going to increase more. So yeah, it's an interesting time to be in the fundraising business. And I think when the IPO window reopens, it'll reinvigorate the venture world to continue to make their bets on future IPOs or future M&A candidates.
Yeah, that makes sense. So how when did you get interested in Coinbase? Because you strike me as a very forward-looking person.
Yeah, so it's been a while. I was at Coinbase back in 2018, so it's time has ticked on. But I become just a huge fan of the company as well as the industry. So I got a call in late 2017 by a recruiter and asking me if I had ever heard of Coinbase, and I said no. And they said, "Well, do you know anything about cryptocurrency?" I said, "No." "Do you know anything about Bitcoin?" "Well, I've heard of it, but don't know much." "Do you know anything about running an exchange or a brokerage operation?" The answer was no. So obviously I was the right candidate for the job. So I got fascinated. Like I became a sponge and I wanted to learn more. They got me in touch with their head of operations, who was, a fairly young person. And I can kind of go through the exec team when I was there is completely gone, except for the CEO. So it's a fast moving organization. But I had a phone interview with the then head of operations, who took a liking to me. He introduced me to their chief legal counsel, who was the head of compliance also, who really was the more mature person on the executive team, who really noted that they needed to bring in someone to help the finance function because it was not built yet. And ultimately, that interview went well. And then I got an opportunity to meet with the CEO, Brian Armstrong, and I scheduled I live in the South Bay, so it's about on a day with moderate traffic, driving from Los Altos, where I live, to San Francisco is about a 90-minute drive. So I gave myself 2 hours. And it turned out there was a massive accident near the ballpark. So I had to take all kinds of detours. I'm late for the meeting. I thought, that's it, meeting with the CEO. I'm late. I'm
This is terrible.
never going to get that job. So, and I don't know the city that well. I know it well enough, but I parked there on one front street. I parked on 400 front street, so 4 blocks away. Ran to the office. Got on the elevator, 31 flights up, out of breath, sweating, and there was Brian waiting in the lotus position with his computer in the waiting room, and said, "Come on in, no problem." So we sat. I was out of breath. I couldn't even put two words together.
I've been that guy before.
And at the end of the conversation, I think I gained my breath about a half an hour into the meeting after drinking some water, and was able then to hear what Brian had to say and what he was thinking of doing with the company. And ultimately, Brian's a guy who really likes people, and I wouldn't say judged, but values communication, and the way people communicate really, really, that's a very, very important for him. And it's funny, at the end of this hour meeting, he said, I really like the way we communicate. Probably because I wasn't talking, but it led to hiring me. And so I joined and was there about a year, and I was brought in to specifically build and manage their global financial operations and financial initiatives. And interestingly, when I was there, the top line grew over 60x, from 17 million in net revenue. That's basically the commissions people pay on their trades, to nearly $1 billion over that 1 year period. It was really an exceptional time. And I helped the leadership team who were going through this for the first time, help them scale the business. I helped transform the company and its control environment from a startup to a well-run and mature organization, capable of continued profitable growth, and getting them ready for an IPO, which was something that they had their mind on, but it was pretty early in the process. So when I arrived there, the finance department was virtually non-existent. It was really 3 people and a dog, literally. I think it was a dog that ran around, but they were underqualified for the role. There were a lot of issues. I don't want to get into any specifics, but there were a lot of issues that were lacking controls. And I helped them organize and develop a robust accounting control environment and the capabilities on the accounting side. For example, breaking their platform accounting separately from operational accounting, which had not done before. Also grew their international tax function, which we had international operations. We didn't have any tax function domestically or internationally. So built that, established a global treasury function. We had billions of dollars of fiat that needed to be invested, and banks didn't want to work with us. Literally, we were working with shopping mall banks. No large money center banks would touch us.
Why was that?
They didn't know how to deal with crypto. And it was a whole AML, KYC compliance review. So while there, I significantly enhanced their global banking relationships, having at the time, built 3 global banking relationships with 3 global banks. And because I was working on that plus insurance, because we were insuring not only people's fiat balances, but their crypto balances and the hot wallet. We can get into what a hot wallet is in a minute. But that really allowed me, because I was working with these financial institutions, it allowed me to gain significant knowledge with respect to crypto compliance, crypto security, and the regulatory climate. So it really gave me a very unique way to understand the business while growing it and putting its IPO readiness plan together. And really allowed me to kind of have a perspective that a lot of people don't have. So that led me to doing, several calls with hedge fund managers and money managers who doesn't really, they didn't know how crypto worked, didn't know how exchanges work, how the regulatory climate works, what the competitive threats are, how pricing works, what are the different products and how they interact. But I've done quite a few of those coaching sessions, and that's how this introduction took place.
Yeah.
Anyway,
Yeah.
so yeah, it was a really interesting, fascinating time.
So when you started to research crypto, what was going through your mind, and what was the biggest maybe positive surprise that you found as you got into the research process?
Great question. I became just a student of crypto. I want to learn as much as I could. I read the Satoshi white paper on Bitcoin. I really tried to learn and read and listen to podcasts, whatever I could do to learn everything about what a digital currency is, why it exists, and what it could be, and how meaningful it is. And I think the thing that I think was most surprising to me was the size and scale of the market given its infancy. It dominated dinner table conversations. It got to the point where my wife kind of made it a rule not to talk about crypto at dinner. and so it was it was and it continues to be highly speculative. And when we get into talking about valuation, and not only valuation of underlying assets, but valuation of the exchanges, I think the volatility and the speculative nature of the assets being traded are really the thing that's propping up Coinbase's value right now. And you'll see that they've taken quite a hit from their all-time high, but there is a speculative nature that will need to go away if this is going to become mainstream. And the more mainstream cryptocurrencies become, meaning you can actually conduct commerce with crypto, you can go out and buy a car or a TV set or a Starbucks coffee with crypto. When it becomes mainstream and not volatile, then pricing pressure steps in. And you'll see that's happening with Coinbase now. But before I get into kind of the competitive threats and that climate, you going back to your question, what was, I think, the most surprising was the amount of interest in the sector and the nature of with the underlying risks that were dramatic, because think about it, so there's digital assets are the big class, and then within that there's cryptocurrencies as one type of digital asset. NFTs and others are other, but the entire value of all cryptocurrencies worldwide, globally, is what, $2.5 trillion. And by the way, 70 trillion in commercial real estate. It kind of puts it in perspective. But these are global assets, and there's no global regulations. And you see what's going on in the last couple of years. Even Coinbase has done an about face. And when I was there, they were talking about no need to change the regulatory framework, and that the current regulatory structure should be able to adapt to support the regulation of cryptocurrencies. Now they're actually saying no. Coinbase is behind the move to actually build a more centralized governance function that's outside of the CFTC, the SEC, the IRS, or NASD or any regulatory function. So, and by the way, the accountants, FASB, they still haven't figured it out. So there's a lot that needs to be sorted out still. And I think the regulatory side is the biggest uncertainty and the biggest unknown, especially when you start thinking about how are these countries around the world, how are they going to govern cryptocurrencies? And look at what they're doing, shutting down, like China shutting down all digital currency trading except for their own. And then the same is taking place in India. Same will take place in multiple countries. To look at authoritarian governments. Well, how are they going to use cryptocurrencies? How are they going to track spending behavior? It's going to become social credit scores. There's so many unknowns right now, and these are global assets that are not globally regulated. So I think it's going to be a country by country move at first. And by the way, in the United States, it's a state by state move. I don't know if people realize, but Coinbase is a money transmitter, and they need to have a money transmitting license, and that's done on a state level. So New York DFS is the most restrictive of all states to get a BIT license, and other states really follow their lead. At least they have historically. I don't know if that's still true, but I think the regulatory climate is really the big wild card.
Yeah, I mean, it seems to me that the natural question that I had when I started like paying any attention to crypto projects was, it seems to skirt a lot of accredited investor rules, which arguably is a good thing. I don't know that those rules should exist, but I also don't know that they shouldn't. I don't know that I have a strong opinion that's well thought out on that. But I had thought a lot. I was like, this is kind of, I mean, I guess it's the goal, right? Democratizing access to certain projects, at least in ways.
Oh, absolutely. Coinbase's original mission was to create a global, I forgot the exact mission, but I believe it was built on creating an open financial system for the world. And that's a big, hairy goal, right? There's how do you do that? There's a lot of countries where people they're non-banked. They just don't have the wealth to be banked. So with the advent of the smartphone and a digital asset and the trading platform, all of a sudden introducing commercial applications for these cryptocurrencies takes form. And this is not certain, right? I don't know if you're a NBA fan, but I'm a Golden State Warrior fan, and watching some of the playoffs, Steph Curry's on every commercial. It seems like, and one of them's for FTX, which is one of the largest trading platforms in the world. So it's becoming more and more mainstream, or at least people are thinking about it. But still, I think it's still uncertain. You can't really enter into commercial transactions with crypto, but it's changing. Again, I'm fascinated by the sector. I stay in touch with it. I'm an active trader. I have a portfolio, and I'm learning more. I played golf with my son this weekend, and he told me that he just bought this token. I forgot what it's called, like Step or something, and he had to pay for the token, but then they pay him for every step he takes. And I think over the course of playing 18 holes, he made $170, which was amazing. I don't know how they make money, but it's just, there's so many things. It's fascinating what's going on in the sector.
Why do you think the volatility exists like it does? And how long do you think that, this is an impossible question to answer, by the way, but how long do you think it'll take till it starts to smooth out and maybe trade like a more regular asset?
I think
Or asset class is probably a better.
Sure. Well, think about who trades. There's the consumers that are retail investors that typically don't know. They're not technical. They don't do a lot of diligence. They're working off of either rumors or what they read off of Reddit or whatnot. And then there's the day traders. They're a step toward more of a professional investor. And then there's the institutions. And the large institutional traders are becoming more and more pervasive. There's more of them, and it took things like Coinbase building their Prime offering, which includes a custody product, to get these institutions comfortable that not only will the assets be safe under custody, but they can be traded. There's liquidity pools that they can get access to. There's prime brokerage operations available to them. But at the end of the day, I think the underlying compliance, meaning that if there's banking and banking fully accepts crypto as an asset class that they're willing to allow to be traded. Right now, well, when I was at Coinbase, the large credit card companies wouldn't work with us. And in fact, they prohibited any crypto from being purchased using a credit card. And now you can. I think Visa has a relationship with Coinbase, as well as supporting crypto on their own. I think they've made some investments in crypto companies. But on the banking side, just the large banks being able to onboard and offboard fiat crypto and crypto back to fiat, that takes a really deep compliance operation. And so things like transaction monitoring automating the monitoring of fiat currency transactions, deposits and withdrawals into and out of your wallet, your digital wallet, whether it's on Coinbase or anywhere else. Risk scoring on a consumer level, very similar to how consumers would be risk scored in a commercial credit card setting. So, making sure that all customers act within their risk tolerances. Queue logic, understanding the queues of identity management, unusual activity, red flags, and various topologies tailored to the various crypto exchanges' business models. All of this, needs oversight, policies, training, processes and controls, to deal with things like transaction monitoring or investigations. There's OFAC and sanction screening. There's just a lot that has to be built on from a compliance perspective to look and feel like a traditional financial institution that has evolved over hundreds of years in the United States and other countries. So that and the regulatory climate, like I mentioned, it's up in the air. I mean, think about the regulatory climate right now. Crypto the regulatory framework's been patchwork. It's been fragmented. Coinbase always played nice with regulators. I think that's what gave them a leg up, because they were U.S. based. They weren't, based in Malta or some other country that you didn't have due process if you were an investor and something went wrong. But Coinbase always played nice with regulators, and they built those relationships, that allowed them to get their licenses, like the BIT licenses in New York. And it's paid off. It gave them a competitive moat. But when you think about how are U.S. Digital currency exchanges treated, they're in the same regulatory category as a traditional AML gatekeeper, any financial institution or money transmitter, right? So they have to apply the same regulations. This is under the amendment to the 2021 BSA, the Bank Secrecy Act. So, cryptocurrency exchanges in the United States, kind of fall under that governance. So there's FinCEN involved. FinCEN does not consider cryptocurrencies to be legal tenders. So enter the IRS. How do they view it? They view crypto as property and it's taxable. Meanwhile, the SEC indicates that cryptocurrencies could be considered securities. In fact, that's one of the reasons why Coinbase started its prime brokerage operation, just so it didn't get shut down. And if in fact the SEC deemed that we were trading securities that need to be registered. Then the CFTC, even though they adopted a friendlier kind of do no harm approach, they recognize these assets as commodities, right? And then FASB, they don't know what to do. They haven't actually come out with any guidance And so most people, if you look at any institution, even Coinbase holding cryptocurrencies on their balance sheet, they consider them an intangible asset with an indefinite life. And for those non-accountants out there, you can only impair an intangible asset. You can't write it up.
Yeah, interesting.
So take Tesla. They bought, what was it, $1.5 billion worth of crypto. I think it was Bitcoin. And if that were to have traded down to $1 billion at the end of a quarter, they would have to impair it. And then let's say it traded up to 2 billion or 3 billion, they couldn't write it up. So they'd have a $3 billion asset on their balance sheet recorded at $1.5 billion or $1 billion. It's not there yet. So it's, you asked me, forgot what the actual question was, but some of the risks of this becoming widely adopted, the things that are holding it back is this, I think, the regulatory climate.
Yeah, it'd almost be better if they were treated as trading securities from an accounting perspective, because then you could write them up, right? But then your income statement would be quite a bit more volatile, I think, right? Or do I have that wrong?
It's interesting. And this, I'm not saying anything that's not publicly available, but if you were to look, and this is one of the things that, if you look back at some of the surprises I had in my days, early Coinbase, I actually kept a list of shock of the day, and it's a long list. And someday when I write my book, I'll reveal some of the shocks. But one of them was that because there's such volatility in these underlying assets, and the way that Coinbase really started itself is when you bought crypto, let's say use Bitcoin as an example. If you bought one Bitcoin from Coinbase, you bought it from Coinbase. You bought it out of their treasury. And when you sold one Bitcoin on the Coinbase platform, you sold it back to Coinbase. So Coinbase had hundreds of millions of transactions that had a gain or a loss on that digital asset sale. And I don't want to get into the details, but even though none of the big four would audit us, they all did something for us as far as building the control environment of Coinbase. They were willing to act as advisors, but again, they couldn't audit us. Not now, I believe the big four has figured it out. But the main reason was they didn't know how to track the gain or sell on these assets. And so when you look at the Coinbase income statement, there is actually a line, might be other, but it's revenue or it's a gain or loss on those transactions, which is fascinating. And then there's all kinds of other issues that make it even more complex. Like, I don't know if you know what a hard fork is or an airdrop, but there's the creation of these new assets out of thin air, and they're associated with other digital assets. And so who owns those assets? And if you're custodying an asset for somebody and there was an airdrop in the middle of that, and who's the recipient of that new asset? So anyway, we're going to take it down. I'm going to take it down the wrong path here.
No, I like this. I actually like where you're going with this, because that's interesting. It's like if you bought my inventory and then while you were holding it, there's an airdrop. I mean, I assume that you're the one that owns it, but if you're trading it, like, is there an argument to be made that I'm actually the owner of the asset? And you're sort of like I talk to my buddies that trade oil, and I think they have like 65% of their gains are long-term because they're deemed always in the market participants, which is different than I would have often thought. I just kind of wonder if there's like issues like that pop up, who owns what, if somebody's trading it, but Coinbase is always the one that's inventorying something. That's an interesting issue.
Yeah. So interesting. So enter the conversation of principal versus agency trading. So a principal trading is when the brokerage completes the customer's trade using their own inventory. And, agency would involve brokerage finding a counterparty to the customer's trade, which can include customers at the same brokerage or another brokerage. So principal trading allows brokers to also profit from the bid-ask spread, which Coinbase benefits from. They benefit from a lot of things. I think the risk and volatility of the underlying asset, although they would like, at least ostensibly, would like there to be more certainty and for crypto to become more mainstream. And when that happens, their spreads are going to decrease and revenue is going to follow. But also, they make money off the bid-ask spread. And in agency trading, which by the way, Coinbase does offer on their OTC product, the broker's finding a willing buyer or seller of a security at the same price, as the counterparty. So Coinbase participates in both, but on the agency side, only under their Coinbase Prime offering on their OTC trading desk. I don't know if I answered your question.
Yeah, no, you did. Do you want to talk a little bit about hot wallets and cold wallets?
Oh, sure. So I think the easiest way to think about it is when you own a digital asset, there's a private key and a public key. And the public key is on the blockchain for all to see. Hundreds of thousands, if not millions of nodes worldwide will have access to the public key. And so unlike popular culture that thinks that crypto and trading crypto is a place for the dark web and for criminals to behave, it's actually the wrong place to hide because all the transactions are traceable. The private key is something that you can either keep on your own on a flash drive or write it down on a piece of paper or have a custodian track it for you, like setting up a wallet service like a Coinbase. That's where I keep mine. Interestingly enough, Coinbase doesn't charge for their wallet service, although there's tens of millions of customers that use that service for free. And so, which is good for them because ultimately when they trade, they're going to take it out of their wallet, take their capital out of their wallet and put it to work on Coinbase, hopefully. But going back to hot wallet and cold storage, so typically think of the hot wallet as a bank teller's drawer where they have access to a small amount of cash, and the cold storage as the vault in the basement that no one gets in. It's opened, once every 2 weeks or whatever. So the cold storage is where 98% of all Coinbase's crypto is held, or at least that was the percentage a couple of years ago. I doubt it's changed. And the hot wallet is what moves in and out and is what's traded. So remember, at Coinbase, just like most exchanges, by the way, don't have the ability to onboard and offboard fiat to crypto and crypto back to fiat. Coinbase is one of the few, and that's where the money transmitter business comes in. There are several brokerage operation exchanges that only allow transfers in and transfers out. And when you transfer, let's say you transfer a Bitcoin in, now you have one Bitcoin at Binance, call it, in Malta, and now you can trade that on the Binance platform for Polkadot or Solana or whatever. And then, but when you want to move it off of their platform, you can trade it back into Bitcoin and then transfer that back into your Coinbase wallet if you want. So it's very complex, and trying to track cost basis gets really, really meaningful. But going back to the hot wallet cold storage, when I was at Coinbase, our hot wallet, by the way, that hot wallet was insured. We told all of our customers that not only have we not been hacked, you might have remembered the Mt. Gox hack, which was, I think at the time, $500 million or so. And then there was a recent hack, I think it was 4 or 5 years ago, by a couple in New York. I don't have all the facts in front of me, but I think they stole about $70 million of crypto. And because of the crypto market just expanding at the velocity it did, I think that value became $4 or $5 billion, and then they ultimately got caught. But anyway, that's just some examples of getting hacked. Coinbase has never been hacked, and I think it's due to the fact that security and compliance is core to their culture, and they put a lot of money into security and are leading at least again, I can't compare the details of Coinbase's. In fact, I was prohibited to know the details of security, although I had to know enough to explain it to the bank regulators. But when we went deep into that was I was not included in those conversations. but we were offering insurance on our hot wallet balance, and so we reached out to the traditional insurance market. And when I was there, I think the hot wallet when I started it was like $20 million fiat USD, and then it quickly grew in the first month or so to 50 million, and then it got to the point where we couldn't buy insurance; it just wasn't available. That we tapped we tapped out the market. We actually had to build our own captive insurance company to insure that hot wallet as it grew to hundreds of millions of dollars, just because of the value of the underlying asset and the amount of activity. And so, 2% of a number that's growing just continues to grow itself. So the way that Coinbase really protects itself is through this ingrained culture of security and making sure that there's no one person actually has the keys. And so it's an incredibly complex part of their business. In fact, even though Deloitte didn't audit us, Deloitte built our SOC 2 compliance around security, which was one of the projects that I was involved in when I was there. But security is paramount there.
Yeah, I wonder if it was you that was interviewed, but I also read that AML is very, very prioritized there. I don't know about relative to other people, but I do know that the transcript that I read had mentioned that. I mean, I guess you have to have your AML airtight in order to operate that business and go public and have confidence you're going to be around.
Yeah, AML, KYCC, know your customer's customer. All of that is absolutely important. We talked a little bit earlier about some of the current controls, AML controls, but transaction monitoring. That's another thing that we did not have a transaction monitoring tool for fiat transactions and crypto transactions. So we used a third party, which cost us a boatload. Now, at the time, Coinbase was printing money, and they think they still are. They were doing the equivalent of a Series C financing every day, about $25 million of free cash flow every single day coming into the bank. And that was done, by the way, on the back of zero sales and marketing. $0.00. It was all word of mouth. When I joined, we're somewhere between 10 and 20,000 new customers per day. At our peak, I think it was over 400,000 new customers signed up for accounts in one day.
Oh, my goodness.
That was done with no growth, growth marketing. Now that's changed. Obviously, they're running Super Bowl ads, and you can't find an NBA channel without the Coinbase logo. But so obviously they branched out. But yeah, AML, KYC, it's critical, and all the banks, any bank, whether it's a tier 2 bank, they will put their compliance team on high alert, and they will come in and do a full scrub of the AML KYC processes under, there's a BSA team, the Bank Secrecy Act team at Coinbase. And it's a central part of their business.
Must have been a crazy time to be there with all that growth, just like going to the office and seeing the whole market explode, right? And well, I guess I don't even know that you were at the office.
We were at the office.
I assume so.
Yeah, wow. Yeah, it was one front street. Moved offices, I think 3 times when I was there. It just grew so quickly, but it was a crazy time. I mean, I felt elevated, like 5 feet off the ground between my house in the morning and getting to work. And I had to force myself to leave at 8:00 every night because the parking garage that I parked in was closing at 8:00. So it was extremely fascinating time. And at the same time, kind of going back to what I was building. I was building an accounting organization, a finance organization. There was no budgeting process. There was no forecasting process. No treasury. We were moving. Oh, that's another shock of the day. We had to move billions of dollars of fiat on a daily and weekly basis. And again, I don't want to go into the details, but it was shocking who would take the money and who wouldn't take the money. But yeah, it was like I said, I'll write a book someday, and this will be a couple chapters for sure.
Yeah. Well, it'd be fun to read. As you know, a question that I have to ask, because a lot of the listeners are buy side or investors or whatnot. If as a CFO, what were some of the questions that you used to hate to get, and how can people talking to the CFO of a company make sure that it's the most productive use of time for both the CFO and the person that's asking the questions? Like, what are some? Do you have any memorable sessions of people asking questions that you were like, this person really knew their stuff and added some value here, versus kind of the questions that bored you?
Yeah, I think that that question kind of transcends any one company. I mean, clearly, for a company that's growing at 6,000% a year, it's different than a company that's growing at 50 or 100% a year. But it really all depends on the stage of the company. One thing that you want to do as CFO is instill confidence in the investment community, and how you do that is, number one, being attentive to detail, and being able to answer questions gracefully and with enough detail that you're not giving away proprietary information, but also you're giving accurate and timely information. So the thing that I think is the most difficult to answer is when you're earlier stage and you don't have all those controls and processes worked out, and you do give guidance that ultimately could change because of the way that you maybe made some accounting changes, or things that weren't recorded properly in the company's past, that once you clean them up, there could be a dramatic change in how a transaction or a series of transactions are recorded. So to give it a little bit more color and certainty around that concept, early stage companies maybe they don't follow ASC 606 properly, so they're not recording revenue and incurring costs the appropriate way, like deferring commissions over the life of the customer, for example, or stock-based compensation, or internally developed software. Those are all really big, hairy beasts that need a lot of technical accounting oversight, and earlier stage companies don't really have that. And so if you put out numbers, you have to be sure you call them preliminary and unaudited, where a lot of early stage companies just rely on the audit, right? And even if you get an audit at an early stage company, that might not put it through the same standard as you would as if you're more mature. I don't know if your listeners know the difference, but there's really two levels of audit standards. One is AICPA and one is PCAOB. PCAOB is the public company standard. And so the level of detail is, 10 times more. I'm just throwing that number out, but it's an a lot more detail. The sample sizes, the materiality standards, those types of things are much different. But even if you're an AICPA standard, if you're a very early, seed stage company, you might get a clean audit, when the reality is you had a lot of material weaknesses that were really never called out because it just, the investors didn't really, those seed investors weren't really focused on that. But then you get closer and closer to becoming, being scrutinized under PCAOB standards, which you have to be to go public, by the way, and you have to go through a few of those cycles. Now, all of a sudden, segregation of duties comes into play, or materiality of how you track something, or how do you account for debt? A lot of people don't know that, companies are doing, and you probably have heard of safe notes, or like a convertible debt offering. The underlying accounting is dramatic, and not many people do it accurately. And so when you actually go back and get your valuation based on the optionality value of the underlying conversion feature, that changes earnings. And so I'm just using a couple examples of things that people don't really focus on, but the CFO needs to, and how you represent them to investors is critical. Also, the other thing that I think is the big change is how you communicate to your own employees, and just what level of detail are you able to give your own employees. As you get closer and closer to being public, there's this concept of Reg FD, that's fair disclosure. So you make sure you have to say the same thing to everybody and not different things to different investors, or something to your employees and something different to an investor. It's and that change, it kind of rubs in the face of the culture of startup communities or startup companies, but it's part of that evolution and change. And I think the one thing that maybe is, I don't wouldn't call it frustrating, but something that I have to be temperate in is how quickly that do I push a company to behave more like a public company than a nimble, reactive startup. And that's a really fine balance. And the last thing you want to do is kind of shut down innovation. And a lot of people don't understand, especially earlier stage companies don't understand process. They think it's process for process sake versus, what is the real reason for it? And until you've been in a company where there's a lot of movement and a lot of changes on how to treat the same exact behavior, it's really hard to understand just how difficult it is to navigate those waters.
Yeah, I would think that would be, because especially in the smaller companies, I would imagine the culture is let's just run and get stuff done. And if you're the guy that comes in and says, "Hey, we need some process here," that would be you're sort of the bearer of bad news.
Yeah, absolutely. And that's kind of like, so I think of the CFO kind of like the goalkeeper on a soccer team. Same with the general counsel. We're there to prevent goals from being scored against us. We're rarely the ones that are scoring goals. Maybe in an M&A setting, we would, help acquire a company. But that's the role of marketing and sales and product. And so that's hard to do. It's hard to get the company and investors know that you're there to protect them and to grow in such a way that you're protecting yourself from being scored upon, meaning a lawsuit or any kind of dramatic change in the way you are recording revenue or your financial statements, et cetera. So getting it done right, it takes time. It's maybe your listeners haven't talked to somebody who's taken a company from earlier stage through the IPO preparedness process, through acting like a public company, and then actually going public and working under a Sarbanes-Oxley SOX environment. It's each one of those steps is so different, and it takes time. I would say rule of thumb is somewhere between 2 and 3 years of effort and $3 to $5 million of cost just to kind of get your controls documented, systems designed and implemented. And there's certifications that the CEO and CFO of a public company need to make. It's under Rule 302 and 404, which indicate, and it tells the investment community, that the CEO and CFO have not only participated in the design and implementation of a functioning control environment, but they've tested it and it works. And then you get third-party attestation later. That's like a year or more after going public. You get your third-party auditor to say, "Yep, the management team says the controls are working. We tested it and we certify that they are." Or if they're not, they have to certify that they're not. Talk about a big hit to your stock price. So it's not for the faint of heart. You live in a fishbowl when you're public, but there's a lot of reasons to go public. So, and not to say that Crexy wants to go public. What we're doing is building a company that's ready to go public. So big difference there.
Yeah, yeah. What do you think some of the valid reasons to go public are?
Well, the easy ones are it's a medium of exchange. It's a public currency. You can use it for acquisition purposes. You give liquidity to your investors and your employees if they own stock or stock options. So it's a good way to provide liquidity for compensation for your employees. And not all companies provide stock options, but most tech companies do. And then there's the the ability to show confidence to your customers and your potential customers that your financial information is accurate. It's been reviewed and scrutinized not only by an audit firm but by the SEC, and so it's publicly available. You get there's more publicly available information that's verifiable, and so it gives your customers confidence that you're going to be around for a while. There is a lot of transparency to how the company's run and operated. So third parties or people outside the company can get comfort that the company is it's operating effectively. And I think there's multiple more reasons, but I think one of the biggest ones is access to capital. We talked about follow-on offerings, or public debt offerings, you can get access to that much more easily than going through the private market, and it's it's perfectly priced through market pricing. So there's a number of reasons to go public. And by the way, the investors are the ones that make that call, not the management team. The people that own the stock. And in venture-backed companies, the people that own the stock are typically the earlier investors, and they're the ones that are looking for liquidity. Most of them are venture firms. They have, they invest out of a fund, and that fund might have a finite life. And at that end of that life, they would like to liquidate those investments. And so to be able to provide returns back to their limited partners, which then allow them to raise the next fund. So that's at the root of venture-backed investing.
Yeah. It's very interesting. I'm trying to learn the art of looking at younger companies and these growth companies. There's a lot of, I think, expense revenue mismatches in the accounting and whatnot that makes it a little bit more complicated than mature companies, but that also creates the opportunity, I think.
Absolutely. And like what we just talked about, you don't get perfect information out of a private company. You get very limited information, actually. So the best way to get better information is make an investment in the company and get information rights. And then you're able to get access to lots of data. But at the end of the day, earlier stage companies, it's really driven by boards and management team. But and there's a lot of speculation, by the way, in venture-backed investing. But it's an interesting position to be in, being in the CFO seat. Having raised approaching $4 billion in capital in multiple forms, I've seen a lot. I've seen how the financial sponsors work, what motivates them, how boards and management teams work, and there's this confluence of interest, which is interesting. I kind of made it up, and I don't know if it's self-evident, but when a company is young, you've got a management team and you've got investors that are kind of at the opposite end of the spectrum as far as what you're looking to get out of that relationship. The investors obviously want to show growth really quickly, profitability, payback on their investment, and the management team wants to build a company for longevity and make deeper investments and not so focused on earnings and profit. But as you get closer and closer to an IPO, there's a convergence of interest. And at that moment that you go public, it's perfectly aligned. The moment after you're public, they start diverging again. And 3 months after the IPO, all of your board members are gone. You've got a new board. The original investors are out. They sold all their stock. And now the management team's left to run the business. So it's a fascinating kind of walk through that process. And it's like I said before, people that have been in the end zone kind of know what it feels like and what's important. And so that's why I think that it's so important for earlier stage companies to get that level of seniority and experience on their management teams.
The interesting thing too about what you said is the moment you go public, the interests are perfectly aligned, and then after the board changes over, I assume the board probably is is looking at the business through a slightly different time horizon, right? Like venture investors look at things different from public company investors, and I'm sure the boards have different lenses too. It's probably some of the reason that I think between that and incentives to sort of juice growth before going public, that's probably some of the reason why coming public is a tough moment. Like the year after is a tough moment for a lot of companies.
Yes. Yeah. And then there's, obviously there's other factors that private companies don't need to really focus on it. Board independence, diversity and inclusion, making sure that there's a ESG, the environmental impact on the company. The company needs to disclose. There's so much more these days, and as regulations continue to evolve, it becomes harder and harder to act in a public company. And by the way, there's not technically a tax, but there's a cost of being public that a lot of companies don't really factor in. Aside from just the need for certain types of people to be hired and exist that aren't needed when you're private, like an investor relations team or an SEC reporting team or a diversity and inclusion team or ESG team. Those don't really need to exist as a private company so much. But board independence too, and getting independent board members. Also, you'll notice like what's going on with Twitter these days. Look at the board. They don't own shares. There's only a couple of board members that have more than 1% of the company. So there's how do you get alignment there? There's activist shareholders. Fortunately, I've never had to deal with activist shareholders, but as soon as you have an earnings glitch, if you miss your earnings guidance and the stock drops and you get class action lawsuits, all of a sudden there's activist shareholders that are coming in, buying up stock, that take board positions, are stacking the board to their own benefit and start milking the company for its cash or whatever. So it's a kind of a bare knuckle environment, right? And I don't get me wrong. When Crexy's ready to be public, I'm looking forward to being their public company CFO. It's just we got to be dialed and ready at that point.
Yeah, you got to be ready for the big leagues and then enter them. Right? You don't want to go prematurely. Yeah. Well, I've really enjoyed getting to know you, and I've enjoyed talking to you, and I appreciate you coming on the show. It's been fun.
Well, I appreciate it too. It's fun. I'm sorry we didn't get a chance. We really just scratched the surface on Coinbase, and it's such a fascinating company.
I mean, I'm good to keep going if you want. What's the most fascinating thing?
I think, and I know we're kind of running up against time here, but if you think about Coinbase today, they have a large number of retail users. I think it's 70 plus million, and sub 10,000 institutional customers. And the company participates pretty broadly in the crypto economy, and I can get into what that means in a minute. But most of the revenue, call it about 85% of the revenue, comes from transaction fees. And interestingly enough, Coinbase's institutional volume accounts for about 60% of its total transaction volume. But the greatest source of the revenue is from retail transactions. And that's due to the fact that they're probably the most expensive platform out there for trading crypto, especially on the retail side. They have a blended average fee of about 140 basis points. And that could get as high as 500 basis points, depending on what type of account you have, how you onboard fiat cash, if you're using credit cards or debit cards. There's all kinds of reasons why your fees may vary. But retail investors don't, in a speculative climate, don't care. If they think they're going to make 1,000% return on their investment, they don't really care that they spent 5%. But that's changing. And especially as I talked before, as crypto becomes more mainstream. But on the even though the greatest source of revenue is retail transactions, the greatest source of trading is on their institutional business, which is about a 5 basis point fee. And like we can get into the details on the fee, but that's super, super interesting. Now, what Coinbase is trying to do, and this is public, and you can read it in their transcripts of the last couple of earnings calls, they're trying to branch out into more subscription services. And this is recurring revenue. They need to get something going where they're not so dependent on transaction volume and the volatility of the underlying asset. So if you look at Schwab or TD Ameritrade or any publicly traded exchange, if you can identify the volatility of the underlying assets and the market cap of those underlying assets, now you've got the ability to forecast revenue. Until then, you can't. And so I think that's why Coinbase has really seen some difficulty and some volatility in their market cap, and their stock price has dropped over time. And I think this is really what they're trying to do is build a repeatable revenue stream. And if you think about like, how are they doing that? So this has evolved over time. And this is, I think we can end the conversation after this because it'll take a few minutes. But
okay.
Coinbase initially started by building their prime brokerage operations, consumer operations, their commerce operations. They have a lot of different products. They offered a UST coin, which is a stable coin. They've got a lot of different products that they've offered, but none of them really gained traction like their transaction business. And so what they've done is they built something called Coinbase Cloud. And why I think Coinbase Cloud is so interesting, it's a turnkey infrastructure that allows for their customers to get access to different types of services. What they want to be is really the OS of Web3 and allowing the kind of the future builders of this crypto economy to thrive. They're building that through multiple offerings, including, so if you think about what their prime offering is for corporates and liquidity providers, they have an OTC trading desk, they have a custody product. On the cloud side, they give developers this on-ramp to building crypto applications and services and speeds up their development timelines. So think of what AWS did for cloud computing, right? They offer, people don't need to run data centers anymore. The same is true with what Coinbase is trying to do. And I think this is the most exciting thing, and I wish them success, but it allows those development teams to focus on improving their products instead of managing a crypto infrastructure, which you can imagine is really, really complex. And Coinbase is really good at it. So they release
that's
APIs.
Interesting. You become a developer platform potentially.
Yeah, exactly. So they have something called an exchange API, which developers can power high volume crypto trading with this exchange API. Getting access to deep liquidity, managing accounts, getting market data. There's also a commerce API, and this is what we talked about a little bit ago, where people are companies, commercial establishments want to accept crypto payments, and it requires a secure and reliable infrastructure that Coinbase can offer without developers like someone within Dell or Tesla or whatever, Samsung, to have their own crypto infrastructure. There's also, you probably know this, but there's lots of different blockchains out there. And each blockchain has its own structure and its own coding. And so building cross-chain products, if you're a company that wants to work with multiple blockchains, how do you do it? Well, Coinbase offers something.
They create the common language or something.
Exactly. So
interesting.
Each blockchain has its different set of rules governing interactions. And they have, Coinbase is an open source project that, these asset issuers can integrate their blockchains to any crypto product. So that's as long as you're using this Coinbase product. There's also the Coinbase Wallet API, right, where developers can easily support or provide support to anybody that has a Coinbase wallet, making it simpler for users to onboard and transact on mobile or web. And then I think last is identity management, signing in on Coinbase, using Coinbase. Coinbase allows its developers to use its APIs to to take these permissionless actions on behalf of their customers, like buying or selling or depositing or withdrawing crypto. And it's really a seamless experience for customers. So when you look at Coinbase over time, pay attention to its cloud business. I think if they become the OS for Web3, they're going to really separate themselves. And that could be, it could go from, low teens percentage of their revenue, say, 13, 14% to mid 20s to maybe 50-50 over time. So it's really interesting. I think to me, this all kind of developed after I left, but it's, I think one thing that really separates Coinbase from others is its ability to make, this competitive moat is so deep. They have so much capital that they can put to work. I think that they're in the driver's seat. But then again, as you start seeing pricing compression, it's going to be an interesting time. I think their stock has maybe a little more bleeding to do before it levels out. But it's they're clearly the go-to company on the block.
Well, a fair amount of stocks may have a little more bleeding to do, but there's been a lot of blood already all over. They're not unique in their stock going down versus many of the stocks that I would consider a peer set. When you said the moat is so deep, if you had to summarize why the moat is so deep, I know that you just went through what you said, but is there anything in addition? Like,
Sure.
if you had to give like a elevator speech on why the moat's
Sure.
so deep, what would you say?
Well, they're extremely well capitalized. Number one, right? They even did a debt offering because they took advantage of really low. I think it was a $2.1 billion debt offering last year, as well as their direct placement, and they have the amount of free cash flow is ridiculous. So they have high brand recognition, and it's getting more and more putting dollars behind their growth marketing effort. But just they're a household name. Compliance, I think that we talked about earlier, they prioritize compliance and it's embedded into their organizational culture. They're also a first mover on multiple fronts, even on their direct placement. I think we're the first player to become in the sector. There's not a lot of late stage crypto companies, as I can attest to, because when I left Coinbase, I was looking at other opportunities, and my expertise as a CFO is more in late stage companies, and I looked at a lot of the Andreessen Horowitz portfolio companies, and they were all early stage, and they just didn't need my expertise. But so they're a first mover. They are late stage. They have an extremely large customer base. I think it's larger than Schwab and Ameritrade combined. They've got multiple products and services, and they continue to invest. They make it easy for customers to onboard, and also easy for digital assets to onboard. It wasn't that easy when I was there. They only had 4 digital assets when I joined: Bitcoin, Ethereum, Litecoin, and Bitcoin Classic. And now there's 100 or more. And the reason they were so slow is they were worried they were going to bring on securities versus tokens. And this is the Howey test, and we can get into details later. But anyway, so they make it easy for assets to be onboarded. And if you're interested, or any of your listeners are interested, go right on their website, and there's a digital asset listing framework that I actually helped craft in the early days. It's subsequently got much more involved, but that's how they bring on. That's the framework in which they bring on new assets. They also have a homegrown technology stack. It's going to be really hard to replicate. I think some of the bigger players, like a Morgan Stanley or others, JP Morgan, that have really deep tech stacks, can probably throw hundreds of millions of dollars at this and replicate it over time. But Coinbase has a head start on them. And then I think the just the popularity that they have as a safe harbor of going to a kind of a U.S. backed crypto exchange when you've got uncertainty. Coinbase has really kind of maniacally pursued their compliance and dealing with law enforcement and regulatory bodies and just being on the right side of the law. So it's another so those are kind of what I would consider to be the talking points of their competitive position.
Very cool. Well, thank you for laying it out and sharing your thoughts.
Sure. Well, this has been fascinating, and as you can tell, I love talking about it. It's a fascinating sector, and I'm probably going to create a YouTube channel with multiple segments to talk about this in more detail. So hopefully your listeners will get access to that when it's done.
Yeah, for sure. Let me know, if you want me to ever mention it on the show, or if you have a link now, I can drop it in the show notes. Either way, how do you want people getting in touch with you? How should people follow you?
Well, I'm kind of new to this game. They can, certainly reach out to me just through my personal email. It's tim@laehy.com, Laehy. And if it's something that I can help them with, would love to connect. But I think in the future, it'll be over a YouTube channel.
Okay. Well, I will, when you want me to tell people where to find you on your YouTube channel, I will help you promote it. And I appreciate you being a guest on the show. Well,
thank you, Bill. And it's been a pleasure talking to you.
Thank you. I look forward to our golf game sometime.
Absolutely. Me too.
All right. Take care.
Okay. Bye.